The world appears to be moving from one crisis to another. Missiles are flying, oil markets are under pressure, global uncertainty is growing by the hour, yet instead of soaring, gold and silver are moving lower. That shouldn't be happening, but it is. So what does the market know that millions of investors don't? Is this a temporary illusion, or the first warning that something much bigger is unfolding beneath the headlines? By the end of this video, the answer may completely change the way you look at today's financial system. Welcome to Next Alert. If you're someone who believes that protecting wealth begins with understanding what's really happening behind the headlines, then become part of our growing community by subscribing. Every report on this channel is created to help thoughtful investors stay one step ahead, not one day behind. And before we begin, tell us in the comments, where are you watching us from today? We'd love to know which part of the world is joining today's discussion. The world has seen countless moments when fear sent investors rushing toward gold and silver. Financial crises, military conflicts, banking failures, and political instability have historically followed the same pattern. As uncertainty grows, confidence in paper assets weakens, and precious metals often become the destination for capital-seeking protection. Today, however, the market is telling a very different story. Across several regions, geopolitical tensions are intensifying, energy markets remain vulnerable, global shipping routes face renewed uncertainty, and governments are increasing military readiness as diplomatic relationships become increasingly fragile. Under ordinary circumstances, such developments would be expected to ignite a powerful rally in precious metals. Instead, gold and silver have moved in the opposite direction. To many investors, that reaction appears completely irrational. If the world is becoming more dangerous, why are traditional safe haven assets losing ground rather than gaining it? The answer begins with understanding a principle that separates experienced market participants from emotional investors. Markets do not simply react to today's headlines. They constantly attempt to anticipate tomorrow's economic conditions. That distinction changes everything. While millions of people focus on the visible conflict unfolding across television screens, institutional investors are watching something far less dramatic, but potentially far more influential. They are watching inflation expectations, bond yields, central bank policy, and the future direction of interest rates. These forces rarely dominate newspaper headlines, yet they often determine the direction of financial markets. The chain reaction is surprisingly straightforward. When geopolitical instability threatens global energy supplies, oil prices tend to rise. Higher energy costs spread throughout the economy, increasing transportation expenses, manufacturing costs, and consumer prices. As inflation expectations climb, investors begin questioning whether central banks will be willing to reduce interest rates anytime soon. If policymakers believe inflation could remain elevated, they may choose to keep monetary policy restrictive for longer than markets previously expected. That possibility has profound consequences. Higher interest rates generally strengthen the US dollar while pushing Treasury yields upward. Unlike gold and silver, government bonds provide investors with a yield. As those returns become more attractive, some investment capital shifts away from non-yielding assets and toward interest-bearing securities. The result can appear deeply counterintuitive. Fear enters the market, yet instead of flowing into precious metals, a significant portion of global capital temporarily moves toward the US dollar and government debt because investors believe central banks may respond aggressively to persistent inflation. This is why today's decline in gold and silver should not automatically be interpreted as evidence that investors no longer value safe haven assets. It may instead reflect a market that is temporarily assigning greater importance to monetary policy than to geopolitical risk. But this explanation raises an even more important question. If short-term price movements are being driven by expectations surrounding interest rates, what happens when those expectations collide with the physical realities of the precious metals market itself? Because beneath the daily fluctuations, another story has been unfolding quietly for years, a story involving central banks, tightening supply, and structural forces that cannot be explained by a single week's headlines. And that deeper story may ultimately prove far more important than today's price decline. Every financial market has two stories unfolding at the same time. The first is loud. It dominates television screens, social media feeds, and daily headlines. It reacts to every political speech, every military development, and every economic report. The second story is almost invisible. It unfolds quietly inside central bank vaults, institutional balance sheets, sovereign reserve strategies, and long-term purchasing decisions that rarely make breaking news. Yet history repeatedly shows that this quieter story often determines where markets ultimately move over the coming years. That is exactly where the gold and silver market stands today. While many investors have been watching falling prices and assuming demand must be weakening, another class of buyers has continued operating with remarkable patience. Central banks do not trade like hedge funds. They do not panic when prices fall, nor do they chase markets higher because of excitement. Their objective is far broader. They are managing national reserves that must remain resilient through inflation, currency depreciation, financial crises, and geopolitical uncertainty. This difference in perspective changes everything. When private investors sell because they fear another interest rate increase, central banks often ask a completely different question. How much exposure should a nation continue to have to a financial system increasingly shaped by debt, sanctions, and currency competition? That question has become increasingly important over the past several years. Around the world, governments have been reassessing the composition of their foreign exchange reserves. Holding excessive exposure to any single reserve currency now carries political as well as financial risk. Diversification has become more than an investment strategy. It has become a national security strategy. Gold naturally occupies an important place within that conversation. Unlike government bonds, physical gold carries no issuer risk. It cannot be created through monetary expansion, and it remains outside the direct control of another country's central bank. For many policymakers, these characteristics have become increasingly valuable in an era of shifting global alliances. Silver, although less discussed, is quietly becoming part of a similar strategic equation. Unlike gold, silver is not merely a monetary metal, it is also a critical industrial resource. Modern economies require enormous quantities of silver for solar technology, advanced electronics, medical equipment, electric vehicles, telecommunications, and the rapidly expanding infrastructure supporting artificial intelligence. Every new generation of technology places additional pressure on an already constrained supply chain. This creates an unusual situation. One side of the market is focused almost entirely on interest rates, bond yields, and short-term price movements. The other side is evaluating strategic resource security over the next decade. These two groups are effectively participating in different markets while trading the same metal. That is why short-term price declines can create a misleading impression. A falling price does not necessarily indicate that long-term conviction is disappearing. Sometimes it reflects nothing more than temporary repositioning by financial investors, while strategic buyers quietly continue accumulating assets without attracting attention. The most significant developments in financial history rarely announce themselves with dramatic headlines. They emerge slowly, almost unnoticed, until one day the market suddenly recognizes that the underlying trend had been developing for years. And nowhere is that possibility more evident than in silver itself, where the real challenge has never been demand. The real challenge has always been supply. Imagine waking up tomorrow to discover that the world suddenly needs twice as much electricity, twice as many data centers, twice as many electric vehicles, and twice as many solar panels. But the mines supplying one of the most critical metals cannot increase production for another 5 or even 10 years. That is not a hypothetical scenario. It is remarkably close to the reality the silver market is facing today. Unlike oil, where producers can sometimes increase output within months, or agricultural commodities that can respond to seasonal demand, silver operates under an entirely different set of rules. The market cannot simply produce millions of additional ounces because prices rise or headlines become more alarming. The reason is surprisingly simple. Most people assume silver miners spend their days searching exclusively for silver. In reality, that is not how the industry works. The majority of the world's silver does not come from dedicated silver mines. It is recovered as a byproduct while companies mine for copper, lead, zinc, or gold. That means a copper producer makes expansion decisions based on copper economics, not silver prices. Even if silver were to experience a dramatic rally tomorrow, many mining companies would have little ability to increase production immediately because silver is not the primary reason those mines exist. This creates one of the most misunderstood supply chains in global commodities. Demand can accelerate almost overnight, supply cannot. Now consider what has quietly happened over the last decade. The global transition toward cleaner energy has transformed silver from a precious metal into a strategic industrial resource. Every advanced solar panel requires silver because of its unmatched electrical conductivity. Every generation of electric vehicles consumes significantly more silver than traditional gasoline-powered cars. Modern medical equipment, telecommunications networks, aerospace technology, semiconductor manufacturing, and increasingly the artificial intelligence infrastructure powering massive data centers all depend on the same metal. Each technological breakthrough adds another layer of demand. None of those industries can easily replace silver without sacrificing efficiency or performance. This is where many investors make a costly mistake. They assume a falling price means weakening fundamentals. But financial markets frequently disconnect from physical reality for weeks, months, or sometimes even longer. Short-term traders focus on interest rates. Manufacturers focus on securing inventory. Governments focus on strategic resources. Technology companies focus on uninterrupted production. Each group is participating in the same market for completely different reasons. Meanwhile, inventories continue to tell their own quiet story. Every ounce delivered into an industrial supply chain becomes an ounce that is no longer readily available elsewhere. Unlike gold, which is largely stored for wealth preservation, a significant portion of silver is consumed in manufacturing processes. Much of it becomes difficult or economically impossible to recover. That means yesterday's production cannot permanently solve tomorrow's shortage. The market slowly tightens one shipment at a time, one factory at a time, one solar project at a time, one data center at a time. This is why experienced investors often pay less attention to today's price and more attention to tomorrow's availability. Because markets can ignore structural imbalances for surprisingly long periods, but history shows they rarely ignore them forever. The real question is no longer whether silver faces growing long-term demand. The real question is what happens when this tightening physical market collides with a financial system still dominated by interest rate expectations, central bank decisions, and shifting global capital flows. That collision may become the defining investment story of the years ahead. Every major financial turning point shares one characteristic. Most people only recognize it after it has already happened. During the event itself, the signals often appear contradictory. Prices move one direction while headlines point another. Confidence rises in one market while uncertainty deepens somewhere else. Investors searching for a single explanation usually end up more confused than informed. That is precisely where gold and silver stand today. The market is being governed by two entirely different clocks. The first clock moves quickly. It reacts to every inflation report, every Federal Reserve statement, every movement in Treasury yields, every shift in the US dollar, and every unexpected geopolitical headline. It measures weeks, days, and sometimes even hours. This is the clock financial markets watch obsessively because it determines short-term price action. If inflation remains stubbornly high, central banks may decide to keep interest rates elevated for longer than investors currently expect. A stronger dollar and higher bond yields could continue placing pressure on precious metals, even if geopolitical risks remain elevated. That is the short-term reality. But the second clock moves much more slowly. It measures years rather than days. It tracks mine development, industrial expansion, central bank reserve strategy, energy transformation, technological innovation, and the gradual reordering of the global financial system. Unlike financial markets, this clock cannot be accelerated by policy announcements or delayed by a single economic report. A silver mine that requires 8 years to reach production will still require 8 years regardless of tomorrow's inflation data. A country seeking to diversify its reserves will continue pursuing that objective regardless of next month's interest rate decision. An artificial intelligence company building new data centers cannot simply postpone its demand for critical materials because bond yields moved slightly higher. These structural forces continue advancing quietly beneath the surface while markets remain distracted by the next headline. This is why experienced investors often separate temporary volatility from permanent change. They understand that markets frequently confuse price with value. Price reflects what participants are willing to pay today. Value reflects the economic importance an asset may hold tomorrow. Those two numbers often move together. Sometimes they do not. History has repeatedly shown that periods of maximum uncertainty create both the greatest risks and the greatest opportunities, not because outcomes become predictable, but because markets occasionally overreact to immediate events while underestimating long-term trends. That does not guarantee gold or silver will suddenly reverse higher. Markets rarely move in straight lines. There may be additional volatility ahead. Inflation could remain persistent. Interest rates could stay elevated longer than expected. The dollar could continue strengthening. Investor sentiment could shift several more times before a sustainable trend emerges. Ignoring those possibilities would not be analysis, it would be speculation. At the same time, dismissing the structural forces quietly reshaping the precious metals market would be equally short-sighted. The world is consuming more strategic resources than ever before. Governments continue reassessing financial security. Technology continues increasing industrial demand. Mining supply remains constrained. None of those realities disappear because prices decline for a few weeks or even several months. Ultimately, the investors who navigate periods like this most successfully are rarely those who react first. They are the ones who understand which signals deserve immediate attention and which trends deserve long-term conviction. That distinction has separated disciplined capital from emotional capital throughout financial history. So perhaps the most important question is not whether gold and silver are falling today. The better question is whether today's decline represents the end of the story, or simply the chapter that most people will misunderstand until the next one has already begun. If you found this analysis valuable, let us know your perspective in the comments. Do you believe the market is correctly pricing today's risks, or do you think it is overlooking a much larger structural shift that has yet to be reflected in gold and silver prices? And if you haven't already, subscribe to Next Alert, where every report is designed to look beyond the headlines and focus on the economic forces that shape tomorrow's markets.